Welcome back to Investing Talk Podcast.
Today we're looking at Enphase Energy.
As usual, before we start, subscribe, like, and comment to this video to support the show.
We have to talk about Enphase, ticker ENPH. I mean, this is arguably one of the biggest battleground stocks on the market right now.
Oh, for sure.
If you just look at the solar sector over the last year, it has been absolutely brutalized. We're talking about a slump that has scared away, a lot of retail money.
The chart has been a horror show.
It really has. And yet, when you peel back the layers on this company specifically, and you stop looking at the sector and look at the business itself, you see a gross margin of 48.5%.
Which, let's be honest, is unheard of for a hardware company.
Yeah.
That number just jumps off the page. But I have to play the skeptic right out of the gate here.
Of course.
We can talk about margins all day, but, you can't ignore the massive headwinds. We've got tax credits expiring. We have this softness in the European market that doesn't seem to be going away, and the stock has looked like a falling knife for a while. Why are we looking at this now?
That is the exact question. That's the tension.
Is this just a value trap?
I think the market might be missing the tailwinds because it's so focused on the storm. We aren't just looking at a beaten down stock. We are looking at a potential turnaround story for 2026.
Okay.
There's a convergence of factors here. A new product cycle with the IQ9, a setup for a potential short squeeze, and just a fundamental disconnect between the price and the business quality.
So you think this is the bottom of the curve? Or are we just, catching a falling knife?
I think we're staring at a pivotal moment. It's either a trap or it's the asymmetric opportunity of the year. The risk-reward has shifted a lot.
Okay, let's unpack this then. If we're going to make a case for a turnaround, we have to start with the hard numbers. Let's look at the balance sheet, what they actually reported.
Let's do it. Narratives are fun, but numbers don't lie.
So they just reported Q4 2025 earnings yesterday, February 3rd. The headline number is revenue of $1.33 billion.
Yeah.
Now, year over year, that's growth of 20%. So on paper, that looks pretty good. It looks like the growth engine is turning back on.
It does, and you have to put that 20% in context. This isn't a solar sector that everyone says is dying. To put up double-digit growth when your competitors are guiding down, that's significant.
It is, but here's the catch. Even with that growth, the guidance suggests there's a revenue trough coming in Q1 2026.
Yeah, that's the big overhang.
We are looking at a dip before we see any sustained rise. So the growth number is nice, but it might be the peak before a valley. Why step in now?
That's a fair concern, but you have to look at the quality of that revenue. And this is where Enphase just separates itself from the pack. We mentioned it, but we need to really dwell on this.
A margin.
The gross profit margin, 48.5%, and a net profit margin of nearly 13%.
I want to pause there because I don't think people realize how wild that is. For a company that makes physical boxes and inverters, batteries, that is, that's software territory.
It really is. Usually hardware is a race to the bottom. You're fighting for pennies.
Right, you see razor-thin margins in automotive standard electronics. 48.5% is the kind of thing you expect from a SaaS company.
Exactly. And that signals pricing power. It tells you they are not selling a commodity. They're selling premium tech. Despite the slump, they haven't had to slash prices to the bone just to move units.
So how are they maintaining that? What is the moat here? Because eventually competition erodes those kinds of margins.
It comes down to their proprietary microinverter technology and the IP. Specifically, the new tech they're rolling out, the IQ9, this is a GaN-enabled microinverter.
GaN, meaning gallium nitride.
Right. And for those who aren't electrical engineers, the shift from silicon to gallium nitride is a huge deal in power electronics.
It allows for higher efficiency, right?
Way higher efficiency, faster switching speeds, better heat management, and a smaller form factor. It is a significantly better mousetrap. But it's not just the chip, it's the lock-in.
The ecosystem.
The ecosystem. When a customer installs Enphase on their roof and then adds a bidirectional EV charger and then a home battery system, they are locked in. They use one app for everything.
So the switching costs become incredibly high.
Immense. You can't just swap out one component for a cheaper competitor.
It's the Apple strategy applied to home energy. Once you're in the walled garden, you stay there.
Precisely. And that protects those margins from rivals.
Okay, let's look at the safety net. If things do get worse, can they survive? I'm looking at the balance sheet here, and I have to admit, it is bulletproof.
It's surprisingly clean, isn't it, for a capital-intensive industry?
Total assets over $3.32 billion. The current ratio is at 2, so they have twice as many short-term assets as liabilities. That is solid liquidity.
They're not going to need to do a desperate capital raise that dilutes shareholders.
No, and look at the cash flow. That's the lifeblood.
Free cash flow is the truth.
Last 12 months, free cash flow is $203.4 million.
And that's during a slump. Think about that. Even in a terrible market, they are printing over $200 million in free cash.
And analysts see that rising.
They see it rising to nearly $480 million annually over the coming decade. That is the fuel for the innovation, for the R&D on the IQ9 without taking on massive debt.
Okay, so financially, they are a fortress. The business is solid, margins are huge, cash is flowing. But let's pivot to the stock. You can have a great company with a terrible chart.
And the chart has been ugly, no doubt, but we are seeing signs of life.
There was a wake-up call recently. On January 22nd, 2026, the stock jumped, what, 12.57% in a single day?
That move was critical. When you have a stock that's been making lower lows for months and suddenly it rips like that, it's like a psychological circuit breaker.
Right.
It signals a potential breakout. We're shifting from a sell the rip mentality to a buy the dip mentality.
It changes the narrative from how low can it go to, oh, did I miss the bottom?
Exactly. And the momentum is clearly shifting. We saw another jump of 9.1% in February. That isn't just retail traders. That suggests a structural shift.
That's what I wanted to ask. Is this just noise or is there real money moving here?
You have to look at the volume. These jumps are being supported by institutional volume. It suggests the smart money is starting to accumulate.
They're looking at the same data we are.
Right. The U.S. residential solar segment is showing demand recovery. The market is a forward-looking machine, and it's starting to price in a rebound for later this year.
So the undervaluation is finally attracting flow back into the name.
It seems to be. When a leader gets this discounted, eventually the value investors step in.
Okay, so the charts are heating up. What's bridged to what the street is saying? Are analysts on board with this recovery thesis?
In this case, they're actually getting aggressive. We're seeing some heavy hitters upgrade the stock.
Like who?
Northland recently raised their price target to $62. And, maybe more importantly, Goldman Sachs upgraded the stock to a buy with a $45 price target.
Whoa, Goldman moving to a buy is a green light for a lot of institutional funds. That forces asset managers to take a second look.
It validates the thesis. It tells the market that the worst is likely behind us.
But there's something juicier here than just analyst ratings. You mentioned a squeeze earlier.
Yeah.
Is there a real setup for that here?
Yes. This is the most explosive part of the sentiment analysis. Enphase is being flagged as a top short squeeze idea for 2026.
Okay, so for anyone listening, let's just explain that quickly. High short interest means lots of people are betting the stock goes down.
Right. They've borrowed shares and sold them.
And if good news comes out, they have to buy those shares back to close their position, which drives the price up even more, forcing more shorts to cover.
And you get that vertical explosion. It's a powder keg. And Enphase has all the ingredients. The sentiment on solar was so negative that the short trade became overcrowded.
So those shorts are trapped now.
They're sitting on losses, and if the stock pushes higher, they'll be forced to buy, which just fuels the rally. It's the path of most pain.
Right. And what about the quant signals?
The quant scoring is flashing bullish, things like inventory discipline and cash focus. And if you compare that to their competitors, like SunPower, the signals are neutral or not a buy.
So the market isn't saying buy solar, it's saying buy Enphase.
It's a flight to quality. You don't buy the haystack, you buy the needle.
Okay, I've let you hype this up for a while now. It's time to bring us back down to earth. Let's pour some cold water on this fire.
Fair enough. Hit me with the bear case.
The immediate risk is staring us right in the face.
Mm-hmm.
The Q1 2026 revenue trough. Guidance signals a year-over-year decline for the upcoming quarter.
That's true. Q1 is going to be ugly. No way around it.
And we know why. The expiration of the Section 25D tax credit. Everyone rushed to get installations done in Q4 2025 to lock in the credit.
The classic demand pull forward effect.
Exactly. So now there's a vacuum in Q1. It's like the day after Black Friday. Nobody is in the store.
It's a legitimate hangover for sure.
Then you have the geopolitical side. Tariff pressures on China-sourced battery cells. Those beautiful 48% margins could evaporate pretty quickly if input costs spike.
Supply chain vulnerability is always a risk with hardware.
And let's not forget Europe. Demand there is still described as soft. They are not firing on all cylinders globally yet. So you have a Q1 dip, tariff risks, and a weak European market. That sounds like a recipe for a bad year.
If you look at those factors in isolation, yes, it sounds terrible. But here is the rebuttal. The stock dropped over 60% at one point.
So you're saying it's all priced in?
The market knows about Section 25D. It knows about Europe. It knows about tariffs. A 60% haircut is the market pricing in those risks. At these levels, the bad news is baked into the cake.
So any news that is just bad instead of catastrophic is actually a win.
Exactly. It's all about expectations now. And that cash cushion we talked about, the $200 million in free cash flow, that gives them the cushion to survive the Q1 dip and the tariffs.
And they can weather the storm?
They can weather the storm that might bankrupt a smaller competitor. They are playing offense while everyone else is playing defense.
Okay, let's tally the score. We've looked at the massive margins, the fortress balance sheet, the technical breakout. We've also looked at the tax credit hangover and the tariff risks. Where do we land?
When I weigh everything, the
Yeah.
valuation, the tech leadership with GAN, and the sentiment shift, I am giving this a bullish score of 8 out of 10.
An 8 out of 10, that is high conviction.
It is. Enphase is an undervalued leader. You just don't find hardware companies with 48.5% gross margins trading at these levels. It's a rare anomaly. The headwinds are temporary and priced in. The tailwinds are just starting to play out.
So what's the play here? How does an investor execute this?
I would look at this as a swing trade opportunity to capture that momentum we discussed coming out of earnings, but I'd also keep a core position for a multi-year hold.
So you think there's a longer-term story here?
Absolutely. As the 2026 rebound takes hold and that revenue trough passes, this could be a massive compounder in a portfolio.
Survive the Q1 dip, catch the squeeze, and then ride the 2026 recovery.
That's the thesis.
That's a compelling argument. But I will remind everyone to keep a very close watch on that Q1 revenue trough. If it's deeper than expected, all bets are off.
Absolutely. The data always wins. You have to verify the thesis every quarter.
That's it for today. Don't forget to subscribe, like, and comment. We'll see you in the next one.